Introduction to Stock Market. Explain what the stock market is and how it works, including key concepts like stocks, exchanges, and trading. Investing strategies. Discuss various investment strategies such as value investing, growth investing, dividend investing, and day trading. Buy and hold. A buy and hold strategy is a classic that's proven itself over and over. With this strategy, you do exactly what the name suggests. You buy an investment and then hold it indefinitely. Ideally, you'll never sell the investment, but you should look to own it for at least 3 to 5 years. Buy index funds. This strategy is all about finding an attractive stock index and then buying an index fund based on it. Two popular indexes are the Standard & Poor's 500 and the Nasdaq Composite. Each has many of the market's top stocks, giving you a well-diversified collection of investments, even if it's the only investment you own. This list of best index funds can get you started. Rather than trying to beat the market, you simply own the market through the fund and get its returns. Index and a few. The index and a few strategy is a way to use the index fund strategy and then add a few small positions to the portfolio. For example, you might have 94% of your money in index funds and 3% in each of Apple and Amazon if you think those companies are well positioned for the long term. This is a good way for beginners to keep to a mostly lower risk index strategy but add a little exposure to individual stocks that they like. Income investing. Income investing is owning investments that produce cash payouts, often dividend stocks and bonds. Part of your return comes in the form of hard cash, which you can use for anything you want, or you can reinvest the payouts into more stocks and bonds. If you own income stocks, you could also still enjoy the benefits of capital gains in addition to the cash income. Here are some top dividend ETFs and high dividend stocks you may want to consider. Risk management. Explore the importance of risk management in the stock market, including diversification, asset allocation, and managing emotions. Identify the risk. Anticipating possible pitfalls of a project doesn't have to feel like gloom and doom for your organization, quite the opposite. Identifying risks is a positive experience that your whole team can take part in and learn from. Project risks are anything that might impact the project's schedule, budget, or success. Analyze the risk. Once your team identifies possible problems, it's time to dig a little deeper. How likely are these risks to occur? And if they do occur, what will the ramifications be? How will you respond? During this step, your team will estimate the probability and fallout of each risk to decide where to focus first. Then you will determine a response plan for each risk. Factors such as potential financial loss to the organization, time lost, and severity of impact all play a part in accurately analyzing each risk. Prioritize the risk. Now prioritization begins. Rank each risk by factoring in both its likelihood of happening and its potential effect on the project. This step gives you a holistic view of the project at hand and pinpoints where the team's focus should lie. Most importantly, it'll help you identify workable solutions for each risk. This way, the risk management workflow itself is not interrupted or delayed in significant ways during the treatment stage.